Tuesday morning, December 1991, Moscow. You wake up, get dressed, and walk 20 minutes through the snow to your bank. You need grocery money. Not much, just enough for the week. You have been depositing into this account for 15 years. The balance is 5,000 rubles, enough to buy a small car. You try the door. It is locked. There is a handwritten note taped to the glass. Technical interruption. You try the next branch. Locked. The one after that. Locked. By afternoon, you have walked to 4 different Sberbank locations across your district. Every single one is shut. No explanation, no timeline, no phone number to call. What you do not know yet is this: the Soviet Union is collapsing in real time, and your 5,000 rubles, the number still sitting in the ledger, still written next to your name, is about to become something stranger than zero. Not worthless, something worse. A promise from an institution that no longer exists. By the time those branches reopen, your life savings will buy 2 loaves of bread. This video is about why that happened and which 5 assets survived when everything else did not. Most people think money fails because prices go up. Bread costs more, rent costs more, your savings buy less. That is inflation. Painful, but the system still works. You still have a bank. The bank still has records. You can still access your money, even if it buys less. What happened in 1991 was completely different. Think of your bank account not as money, but as a promise that a specific institution will convert that number into cash whenever you show up. That promise only works if the institution making it continues to exist. On December 25, 1991, Mikhail Gorbachev resigned. The next day, the Soviet flag came down from the Kremlin. And the institution behind your savings, the entire Soviet banking apparatus, fragmented overnight into 15 separate countries, with no agreement on who owed what to whom. The young clerk at your local branch did not know which government employed her anymore. Your balance did not go to zero. It became unenforceable. There was no one to sue, no registry to appeal to, no bureaucracy to process your claim. This is the single most important financial concept most people never think about until it is too late. There is a difference between your balance and your access. The balance can be real. The access can vanish overnight. The 5 assets that survived the Soviet collapse all shared one thing in common. None of them needed a functioning institution to retain their value. Let us go through each one, using documented evidence of what actually happened. The Soviet state had banned dollar possession since 1961, and yet by 1991, an estimated $15 to $40 billion in United States currency was circulating inside Russia, hidden in apartments, buried in gardens, sewn into mattresses. Why? Because a $100 bill did not need Ghostbank to authenticate it. It did not need a registry. It did not need the Soviet state to exist. Any person in any market who accepted dollars would accept yours. Here is what that looked like in real numbers. A factory director in Leningrad kept his monthly payroll reserves split, half rubles, half dollars from the black market. In January 1992, when Soviet price controls lifted overnight, his ruble reserves bought 3 days of operations. His dollar reserves bought 11 months. By December of that year, the ruble portion would have covered 6 hours of payroll. The dollars still covered 11 months. Same factory, same month. 2 completely different outcomes. The only difference was which currency required institutional survival. The ruble needed the Soviet state to remain meaningful. The dollar did not. Gold worked the same way. It did not need Ghostbank to verify its authenticity. Any jeweler, any market trader, any private buyer could assess purity and weight without a single piece of government paperwork. Between 1991 and 1993, gold in Russia tracked international spot prices precisely, adjusted for local demand. It rose from 330 rubles per gram in January 1991 to 32,000 rubles per gram by December 1993. Now compare that to a neighbor who held 50,000 rubles in a standard savings account. In January 1991, That balance could buy 333 gold coins. By December 1993, that same balance could buy less than one. The gold required no institution to remain gold. The passbook required a functioning bank. One asset existed independently of the system. The other existed only because of it. This is why Gresham's law operated so visibly during the collapse. People spent the rubles they had to and held on to everything else. Between 1992 and 1994, the Russian government issued 146 million privatization vouchers, one to every citizen. Face value, 10,000 rubles each. The idea was to use them to buy shares in state enterprises being transferred to private ownership. Here is what happened. A machinist in Yekaterinburg named Dmitry received his voucher in October 1992. 3 weeks later, he used it to buy a small stake in a local metals factory. By 1995, that stake generated monthly dividend payments equal to his entire 1991 annual salary. His coworker held his voucher as a financial instrument, planning to sell it when prices rose. By late 1994, hyperinflation had destroyed 87% of its purchasing power. Same voucher, same starting point. One became a productive asset, the other became paper. The lesson is not about vouchers specifically, it is about timing. The window was open, then it closed. Those who moved early captured real value. Those who waited held a promise that expired. Housing followed a similar pattern. In 1991, the Russian government began transferring apartment ownership from the state to the people living in them. But the registry system was collapsing at the same time. 2 families, same building in St. Petersburg, adjacent apartments. The Petrovs completed their ownership transfer in June 1991, before the chaos. Their certificate entered the new Russian system by 1993. Recognized. Enforceable. Theirs. The Ivanovs submitted their application in September 1991. The office that would have processed it dissolved during the collapse. Their claim, completely legitimate, became unresolvable. Both families had lived there for years. Only one family's ownership survived. Across Russian cities, this pattern repeated without exception. Completed transfers survived. Pending claims disappeared. Physical possession mattered. Paper claims without a functioning administrative chain did not. Now consider productive assets. A lathe does not care what currency is worth. If it shapes metal, it generates value, in rubles, in dollars, or in barter. A dentist in Samara named Irina ran a private practice, technically illegal under Soviet law, but tolerated locally. In 1991, she charged 50 rubles per procedure. By 1993, she charged 15,000 rubles per procedure. But she treated the same number of patients. Her income adjusted automatically to whatever the currency was doing because people still needed dental work. Her colleague at a state clinic earned a fixed ruble salary. In 1991, his monthly pay bought 175 kilograms of bread. By December 1993, the same salary bought 12 kilograms. Irina's productive capacity could not be inflated away. Her colleague's institutional promise could and was. Now look at what failed. Spare bank savings accounts held 375 billion rubles in household deposits when the Soviet Union dissolved. The ledgers still existed. The account numbers were still valid. But the institution maintaining those records had fractured across 15 new countries. A Moscow schoolteacher held 8,000 rubles, enough for a small car under Soviet pricing. By 1994, it bought 2 loaves of bread. The account never closed. The institution giving it meaning disappeared. State pension promises continued on paper, guaranteed by law, calculated by formula, backed by the authority of the state. But the system paying them operated inside hyperinflation. A retired engineer's pension in 1993 bought what 3 days of groceries had cost in 1990. The formula survived, the purchasing power did not. Soviet government bonds also remained physically intact, certificates with serial numbers and redemption dates. But redemption required an institution to honor the claim. That institution was gone. By 1993, they had no market value. The paper still existed. The promise could not be enforced. The pattern is identical. These were not bad investments. They were claims on an institution that stopped existing. No fraud, no theft. The entity that made the promise simply ceased to be. Now consider more recent examples. Venezuela from 2016 onward. By 2019, inflation had become unmeasurable. The central bank stopped publishing data. But the real break was access. Withdrawal limits dropped below the cost of a single meal. Then, access itself became restricted, indefinitely. People could see their balances on screens. They could not use them. Those holding United States dollar cash retained purchasing power. Those holding only Bolivar accounts did not. Same country, same moment, different outcomes. Lebanon from 2019 onward. Banks imposed capital controls without formal policy. Depositors could not access their own dollar accounts, not through regulation, through silence. A dollar account and a local currency account in the same bank became two different assets overnight. One frozen, one accessible but worthless. One businessman held $200,000 in a Beirut bank. He also kept $40,000 in cash at home. By 2021, his bank funds were inaccessible. The cash sustained him for 2 years. The money he considered inefficient was the only money that worked. Argentina shows the same mechanism across decades. During periods of institutional stress, assets requiring state systems lose value first. Assets independent of those systems preserve purchasing power. In 2001, the Corralito froze $67 billion in deposits overnight. Those with external assets adapted. Those dependent on the system did not. The pattern has repeated in 2008, 2018, and continues structurally today. The same sorting process, the same dependency, the same outcome. 2 years after that morning in Moscow, the woman who visited 4 locked banks sits in her apartment. Her neighbor, who trusted the system completely, is still trying to recover his savings. The bank building still stands. The records are gone. His 75,000 rubles now equal 3 kilograms of bread. She did not trust the system more. She simply held assets that did not require it. The dollars on her shelf still hold value. The gold chain she owned traded for months of food. The apartment she lived in required no institution to prove its use. This is the principle that explains everything you have just heard. Wealth does not disappear during institutional collapse. It migrates from assets that require the system to assets that do not. The Soviet collapse gave no warning. Neither did Venezuela. Neither did Lebanon. The difference in outcomes was not prediction, not luck, not status. It was structure. The people who retained wealth held assets that functioned without institutional permission. So the real question is this: which of your assets require a functioning institution to remain valuable, and which do not? That is worth understanding before you need to understand it. If this analysis changed how you think about your financial position, subscribe. Each video examines documented evidence. What happened? Who survived? And the structural patterns behind it. Leave a comment with the modern case that concerns you most, and remember this: safety is not about which assets are guaranteed by the system. It is about which assets do not need that guarantee to survive.